very pleased to be able to speak to John Kay, economics commentator, professor, and someone who's worked very close with the government in the UK, in Scotland, and whose views are taken very seriously in the industry, who has been moving along in his thinking about banking, about the economy. His latest book, Other People's Money, Masters of the Universe or Servants of the People, focuses a lot on where banks are today, how they're being regulated, and where we're going and how they influence the economy in that regard. So this conversation is very pertinent as where we are today. Where are you in your thinking, and perhaps maybe just to draw you out as a person and where you come from? You were a pioneer in a lot of the think tanks that, in at least two think tanks in the UK, where businesses, were part of the process of influencing government policy as the UK was changing from a very Fabian type of economy to what it is today. Just give us a sense of how your thinking has evolved over time, and then arrive at this book, and what are you thinking about a lot today?
I mean, banking has evolved during that time, and one of the things that has influenced the evolution of banking has been that change in intellectual climate you're describing. Essentially, the much greater readiness to leave things to market forces than was true up till the 1960s. But I think actually, as far as the banking and financial sector is concerned, the main effect of that has been negative, not positive. I go back, you asked me where I come from in all of this. I go back to Edinburgh in the 1960s when I was a schoolboy. And then going into the Bank of Scotland, or the Royal Bank of Scotland, that was a career for the boys in my class who weren't going to get quite good enough grades to go on to good universities. And these people would work in the bank for 20 years, become branch managers, and work for another 20 years before they retired with a pension. And they existed in that rather stable world, which everyone imagined would go on forever. And they were very much part of their local communities, and through that knew who it was appropriate to lend to and who it wasn't. And there's this extraordinary paradox that by the time the Bank of Scotland and the Royal Bank of Scotland both went bust in 2008, they were run by very clever people with very good degrees from good universities, MBAs from the best known business schools. And these people, well, we know what happened. They managed the businesses much worse. And the reason they managed the businesses much worse, actually, is that they and others had created a complex environment, an environment so complex that it was beyond even the cleverness of the people who were then running these institutions.
Is it that, I mean, because you do so much of the thinking and writing, is it that we lost the plot somewhat? We lost the narrative as it was being built. You take the time from the end of Bretton Woods, where banking was essentially an asset and liability business, to what it is today, where banks make more money from their trading book than they do from the traditional business. And you just mentioned that less than 3% of the lending is to non-financial institutions in that regard. Did we lose the narrative? It was evolving. It was clear for everyone to see, but we were imagining that it was something other than what it was. By the time we reached 1999, banks like the Royal Bank of Scotland, RBS, had become a trading shop rather than a traditional bank, but they were making decisions as if they were, traditional banks.
I think that's pretty much the case, or at least the trading activity was added on to the traditional bank. And the thesis of this book is that we need to get back to not turn the clock back to the 1960s, we can't do that, but we need to get back to asking what finance is for and how well does finance meet the needs of the non-financial economy. And in my view, banking and finance is about four things. It's about operating a payment system. It's about facilitating wealth management to enable us to manage our consumption over our lifetime through education at one end and retirement at the other. It's there to do capital allocation, to take household savings and put them into worthwhile investment. And it's there to help businesses and households mitigate risk. These are the things we want finance for.
But is it wishful thinking? Is that trajectory that banking is on? Is it raging on? To its logical conclusion in that. The whole thing the whole economy as we see it today is, what I would call the financialization of the economy. Banking looking for all kinds of assets to financialize. FX is the latest frontier in that regard, and then they will keep looking for. If you look at microfinance, for example, it started with a noble model of assets from within the lending that they do to the poor community. And today you have got capital investments coming in from private equities that rip it up and make it very mercenary. Is that trajectory continuing? Is this a helpless book?
I hope it's not helpless, but I think you're making two key points there, which are very much themes of the book. The way in which these core purposes of finance have been overwhelmed by volumes of secondary market trading. So what most people in the finance sector, or in the wholesale finance sector, are doing today is actually trading existing assets with each other, rather than either creating new assets or creating new underlying assets in terms of new businesses, new infrastructure, new business investment, and so on. They're trading in things that already exist rather than creating these. That's one of the important ways in which finance has got away from its purposes. And the second thing you mention, of which microfinance is a good example, of the way in which financial innovation, very often you have genuine innovations that serve a useful purpose for a limited group of functions and people. And yet almost all of these innovations get pursued to enormous success. We have far too much of a good thing in so many cases. And the way in which microfinance was transformed is a good example. One could have loads of examples ranging from what happened with credit default swaps to what has happened with exchange traded funds. All of these useful innovations that became actually damaging when pursued to excess.
But nonetheless, they are still financial tools. Is there a non-financial model that we should be thinking about for hedging, for derivatives that makes them maybe less tradable, closer to their purpose, and therefore less likely to be misused by the finance industry. The point here is that the finance industry cannot help but being itself.
Well, I think we have to change it so that it actually serves the needs of the real economy, rather than go on living in this self-referential world where people are trading with themselves, talking to themselves, judging themselves by criteria they have themselves generated, criteria which are often irrelevant to the needs of the underlying users. Whether that's the obsession with liquidity. I hear people talking every day now about limitations of liquidity. Actually, the amount of liquidity in the financial system that is needed by underlying users is very small. We have hundreds more times liquidity than is actually needed to meet the requirements of people saving for retirement, companies that are raising capital for investment, and so on. The liquidity is there to meet the needs of financial market participants for markets in which they can readily trade. Similarly, asset managers are judging themselves by benchmarks, which are effectively the average of the performance of other asset managers. That's not what people saving for their retirement care about. It's how much money they're going to get in their pension.
Right, and there the question is, what are you paying for in terms of skills? Are you paying to preserve your assets, or to do what you would have done anyway in that regard. So the revenue being generated has to be fit for purpose in that regard. Let me ask you this. It is also my sense that that commercial banking, as it evolved up to 2008, did have a positive element in that it made credit cheaper, or it was a beneficiary of cheap credit in that regard. Now, given experiment,
you mean in the run-up to 2008? No.
Yeah. Given the experiment in the UK today, the challenger banks and the high street banks, the challenger banks are going to constantly be struggling on the cost of funds aspect. Not all of them are revealing too much of their cost to income ratio. In other words, to go back to what banking should be may well be a more expensive proposition than what we have actually created.
You know, I'm not sure challenger banks are central to the reform of the banking system. If I look at where we are in Britain, or indeed in most other countries, it seems to me the problem is that not that we don't have enough banks, it's that all banks seem to their customers to be essentially the same. And that's partly a matter of this self-referential world of the industry, but it's also a matter of regulation, that if you want to be a challenger bank, you're told that to get a license you have to be pretty much like the other banks that already exist, and that's not a recipe for effective competition. It's one of the many ways in which I think regulation is actually failing to serve the underlying interests of real interests of the public in financial markets.
What is your sense of regulation, how it's playing out today? It's becoming a terror in a way to the industry. And the industry is second guessing itself to deal with regulation. What should the role of regulation be, and how can regulation guide the industry to the kind of sustainable model that you're thinking about?
I think we need to rethink the whole philosophy of financial market regulation. You know, the idea that we can regulate any industry by reference to detailed prescriptive rule books is just a mistake, and it hasn't worked anywhere else. And it generates the phenomenon that everyone recognizes in relation to financial regulation, which is it becomes ever more complex and less related to the underlying real needs of users of markets. And that's inevitable because finance industry employs a lot of clever people. Whatever regulatory structures are devised, if they don't go with the grain of what people want to do anyway, they will find mechanisms of getting around them, and that just yields more complex rule books. And we've had Basel I, Basel II, now we have Basel III. I'm sure we'll have Basel IV and V and VI. And I don't know how many we will get to before we realise that what was wrong in the first was not. What is wrong is not that we haven't quite got the rules right yet. It's that trying to regulate banking by reference to these kind of rules was the wrong approach from the beginning.
Think about this. Basel I was a very simple rule, and in fact, Bill Siegman, one of the U.S. representative on Basel I, said it took them 1 day to decide on Basel I. By the time they got to Basel III, it was a year and longer than that. And Basel I was a lot to do with the basic business of assets and liabilities, and you need to have enough capital for your assets and liabilities. By the time we reached Basel III, we would think they were already going into liquidity. Basel II had a lot to do with the institution, and actually Basel II started to deal a little bit with markets. And Basel III went into markets in a very big way. When you look at the regulation regime that is being created, it's almost after the fact, and to deal with a crisis that happened just before. And on top of that, one can argue that the fines that are being imposed today is in a way regulation being a beneficiary of the kind of money that is made in banking.
Right. So what you're describing is really a litany of regulatory failure. That the lesson of the Basel capital requirements, it seems to me, is that trying to regulate the system by this kind of prescription is not going to work. And we've just been through how it's increased in complexity through Basel 1, 2 and 3, and it will go on increasing in complexity, and at every stage people will discover that it hasn't quite had the results they wanted and will add yet more bells and whistles. We can't do it this way. I think what we have to do is to look at a banking world in which we separate out the rather dull deposit-taking banking, which is inevitably going to be backstopped by the taxpayer, and we regulate that rather tightly, and most of the other activities which are part of the banking system today, we separate, and we have much less regulation of these activities, and we allow institutions in these areas of finance actually to go bust.
That seems to be, at the heart of the issue, the ability to allow banks to be run as businesses and to go bust. And it's not so much public opinion, but policy that determines that. And being someone who's been in policy all your life, or rather, being in the business of influencing policy, how do you think that's going to change? At which point will regulators say that banks will be allowed to do whatever they want, and at some point the shareholders backstop them, and if the shareholders take responsibility for the decisions that they make? Well,
this goes straight back to the issue with which we began about the extent of secondary market trading that makes institutions interdependent. Lehman, most people think now it's a mistake to let Lehman fail. But I haven't had nobody who says it was a mistake to let Lehman fail because we really miss the services that Lehman used to provide. The reason Lehman failing, it wasn't even that Lehman was a very big financial institution. The reason Lehman failing was a problem was that markets were so interdependent, so that the consequences of Lehman's failure spread right throughout the financial system. That's why, in my view, we need to address it with a regulatory philosophy that is aimed at the structure of the industry and the incentives of firms and individuals within it, and not trying to write detailed rules. And for me, that means a world of much less secondary market trading, of much less interdependence, in which we have shorter, simpler chains of intermediation directly between, in relation to capital allocation, for example, the households are ultimately providing the savings, and the companies and the home buyers and the like are being provided with capital.
And what you're suggesting here is very interesting. In the US, there is a very clear distinction between Main Street banks and the trading shops out of New York. And by the time you become...
Or at least they used to be.
They used to be.
Yes.
Legally, they're now the same thing. But Goldman Sachs would still, maintain the legal aspect more to protect itself, but it's still very much a trading shop. In fact, one would argue that by being incorporated as a bank, it actually gets into even more trouble as a result. But at least that distinction is clearer in the US than it is in the UK or in Europe, where banks take on the whole spectrum of activity in that regard. So this thing about ring fencing, is that a artificial construct, or is that a natural thing to do to make a distinction between the wholesale activities of banks, where they really have a lot to do with each other rather than with the industry or the man on the street, and commercial banking, where they have to be honest with the man on the street every day?
I think we do need to have that kind of ring fencing. And as I was suggesting earlier, when we do that, we can have tight and effective regulation of the rather dull retail banking sector and largely deregulate the wholesale sector in which people trade with each other. And I think if we deregulate it, we'll actually have much less activity in it, because people will know that this activity isn't backstopped by taxpayers, and what will, as it were, impose capital requirements on businesses will not be a regulator, but actually the prudence of the management of the businesses concerned and the willingness of their counterparties to do business with them. And it is very striking that, as it were, the capital ratios of hedge funds, which we know are going to be allowed to go bust, are so much larger than the capital ratios of the hedge funds which are within commercial banks, which are prescribed by regulators, and where people perceive that there's very little prospect of failure.
In the prescriptions that you are, suggesting in your book, how do you think they're going to work out? What do you think is the mechanism that needs to be in place for banking to be brought back to the sustainable regime?
That's very difficult, because the large part of the problem we face at the moment is simply the political power of vested financial interests as they are at the moment. So that Wall Street is effectively the most powerful of industrial lobbies in the United States, which is the country that matters most for these purposes, although for somewhat different reasons. In other major countries like the UK or France or Germany, the established banking industry, the established finance industry, also has a very powerful influence on politics. I think unless we break that nexus, we're not actually going to get the kind of reform that I think is needed, or a finance system that actually serves more effectively the needs of users of finance. But I suspect it will take another major crisis to do that. Or, and this worries me more, I worry more and more about the way in which the rather unfocused public anger about what has happened in the last decade is translated into support for crazy guys at the extremes of the political spectrum.
When you think about it, all the liquidity that's been created in the market today is created through leverage, and governments becoming leveraged, governments issuing bonds and treasuries. That being the case, we are continuing on that trajectory that where we left off in 2008. In fact, it's larger today given the balance sheets of central banks, who are now a player very much like a investment bank into the equation. We've just actually introduced yet another player into the equation.
Yes, the way in which central banks become de facto market makers in a variety of asset classes as a result of the policies that have been adopted. Yeah,
we're talking the talk, but we're actually walking in a very...
Yeah, I think that is right. And also in what you're saying, there's a danger in confusing activity with liquidity. And much of the liquidity that is apparently created by this activity in the system is illusory, in the sense that when you want it, when you need it, it's not actually going to be there. And that was one of the lessons of 2008.
That's the inefficiency of the system. We haven't even started discussing that at all. That credit is not going where it's supposed to. And all of the new fintech players who are coming on stream, they're suggesting that they can get it to the required users efficiently. But I think that they too will be businesses, and they're not going to be providing credit cheaply. So that's a completely different discussion. But the liquidity has been created. As you say, it's inefficient. And it's not serving the purpose it's supposed to. But the underlying theme is this: that the entire capitalist model is based on the creation of credit. And the distribution of credit, rather than the creation of wealth and the distribution of wealth. Some banks are suggesting that they are reformed today. They want to go into the wealth management business, but the system doesn't give them anything to work with. When wealth is created on the back of even more trading, and asset inflation comes from the rich, being able to leverage what they have even more, and the poor not having anything.
Well, there's an underlying question there, which is something that puzzled me for a long time, and I talk about in the book and try and sketch answers to, which is, where does the profitability of trading actually come from? Because if you lock people in a room and they spend a day trading bits of paper with each other, they're not going to add any value and they're not going to make any gross profit. The amount of money they walk away with at the end of the day in total will be the same as the amount which they came with. And if you ask where the money does come from, then I've come to the conclusion, and I describe this, that part of it is illusory. That part of what happened in 2003 through 2008 was banks announced they'd made very large profits, much of it from trading. They paid a large proportion of these to their senior employees, and then they discovered in 2008 it had all been a mistake, that much of the paper on their balance sheets was overvalued, and they hadn't made these profits after all. And that's how shareholders in several major banks were effectively wiped out. So that some of these profits are illusory, and some of them, like the returns that are generated from high-frequency trading, are basically just a tax on long-term savers and investors, the households that actually want to put their money into the market.
And while we're having this conversation, the financialization of everything keeps raging on.
Yes, and I used in the book the term financialization to talk about the way finance has become central to so much of our lives, whether it's the way in which, to my mind, the rather desirable privatizing of a variety of traditional state functions was hijacked by people who wanted to devise rather complex schemes of financing, or whether, and this is really important, I think, the way in which business is paying attention to stock markets in a way that managers of 50 years ago would never have dreamt of doing. And in the main, the effects of that are malign rather than beneficial for the actual management of the business and the development in the non-financial sector of the long-term relationships with customers, suppliers, employees that are actually critical to what makes business, whether financial business or non-financial business, work.
So in your book, you describe the malady, but not the conclusion in that regard.
Oh, well, I do talk about the remedies. And for me, the remedies lie fundamentally in two areas. They lie in reform of the structure of the industry. So what I want to see are many more specialist institutions rather than the broad-ranging financial conglomerates which we have at the moment. Because they're, as it were, functionally specialized, they will be smaller. And one of the really desirable objectives is that we can let markets work so that firms that do well grow and firms that do badly fail. So we need to reform the structure of the industry to go through the ring fencing which you've described of dull deposit-taking banking from the remainder of the financial system, deregulate very largely that remainder of the financial system, and let finance operate like any other business in a market economy. What we also need to do is address individual and corporate incentives, partly with stakes. That is, I think we should have some kind of strict liability in organizations, in financial organizations, for what happens in them, so that the people who are running these institutions don't have the defense of saying we didn't know what was going on, which is what's made it so difficult to drive home responsibility at the moment. And similarly, incentives that actually relate people's rewards to meeting the underlying needs of users rather than trading in secondary assets.
Final question, which regulatory regimes or which markets do you think are closer to becoming sustainable today after 2008 because of real reforms that they put in place?
I mean, I think the regulation of finance has gone down a path that leads ultimately nowhere. I mean, it's leading us through a maze that actually has no end, and in which we will just get buried deeper and deeper. People sometimes ask me, do you have models of how regulation should work? And I often talk then about the airline industry, which for 50 years, from the beginning of airline regulation in the 20s through to the 70s, went down the path we're familiar with in finance of ever more complex prescription being written from the centre. And there was then a 10-year interval in which we got rid of all that stuff and focused on the issues that really need regulation, which are primarily to do with passenger safety and public safety. And we have today economic competition on one hand and a cooperative culture in developing safety on the other, and what's known as a just culture in the industry, which encourages people to report problems and mistakes and things going wrong. And that's why our planes are safe, our financial system is not.
That may well be the light at the end of the tunnel, as one would say. Thank you very much, John.
Thanks.